Welcome back to the Finance Learning Academy once more. And if this is your first time taking one of our courses, well, welcome just the same. My name is Blair Cook, and I will be presenting this online course all about financing strategies for your business. This is an important issue, and one which was at the central core of the great 2008 recession. And in this course, we are going to learn about the different types and sources of debt and equity financing. The course is designed to get you strategically thinking about your capital structure and then setting course a plan to optimize financing opportunities. This is not a course about who to call or who offers the best rates. Those sorts of financing type issues are far more tactical and change frequently. In my current and previous roles as a Chief Financial Officer, I have seen many types of financing situations and financing instruments. We often use creative financing vehicles in our private equity investments as an integral part of our value creation strategy. Now, before we get too far, I hope you'll forgive me, but I'm going to take a moment here just to remind you that we're going to only touch on the various different financing topics in this course. I actually present this course as an entire one-day live course, and you can find out more information about my next offering on the financinglearningacademy.com website. So let's dive in. Most businesses need capital to exist. The exceptions are few. In fact, unless you can convince your customers to pay you up front for your goods or services before you build them, procure them, or deliver them, then your business is going to need capital to survive. Now let's look at the various potential uses of capital. Capital can be used to fund ongoing operations. I've never met an employee who doesn't like to get paid, and suppliers of similar ilk. Capital can also be used to fund capital expenditures, to build and maintain plant and equipment. Capital can be used for mergers and acquisitions. A merger and acquisition activity allows a company to purchase incremental or adjacent businesses to accelerate their growth. Capital can be used to fund working capital. Everything from purchasing raw materials, assembling finished goods, and selling goods to customers on credit as an incentive to purchase. Capital can be replaced in refinancing opportunities. The idea here is to replace higher cost sources of capital with lower cost sources of capital, replacing equity with debt or higher cost debt with lower cost debt. Recapitalization of the business is another use of capital. Recapitalization covers a variety of circumstances, but for example, capital could be used to buy out a previous owner, or capital could be used to monetize a portion of the shareholder's investment. And finally, capital can be used as a reserve for financial flexibility, or to build financial strength. Companies will hold excess capital for strategic purposes, either as preventative measures to protect the company from downturns, or as an opportunistic measure to allow it to act quickly when opportunities present themselves. You probably didn't think of all these as potential uses for capital. Few people do. Most people think of capital only in the context of paying ongoing bills and funding major capital expansions. Capital must serve both shareholder objectives and corporate objectives, such as those that we've got listed on the screen before you. The corporate objectives and the shareholder objectives do not always coincide. For example, shareholders may wish to monetize some of their investment by using up available debt capacity in the company. At the same time, the company may need new capital to fund a growth plan. And to explain this just a little further, because this is the second time I've brought this up, this would be a situation where the company has debt capacity but has chosen not to use it to this point in time. So the company could raise debt financing and use those proceeds to pay a special dividend to the shareholders or to buy back shares as a means of monetizing a portion of the shareholders' investment without having the remaining shareholders dilute their interest in the company or having them sell a portion of their investment to realize some cash. Another potential area of conflicting objectives between the company and its shareholders is around the issuance of new equity. The company may wish to pursue a growth opportunity but lack the necessary debt capacity or debt funding, and the shareholder may be unwilling to suffer the dilution caused by issuing new equity. And a third example might be when the company may accept new equity or debt financing. However, the reporting or the involvement of the new stakeholder proves to be detrimental to the business. Some lenders have stringent reporting requirements that cause disruption. Some private equity partners may be intrusive to management or have other objectives for the company from those of the present management team or the present shareholder group. Financing strategy must be aligned to the corporate strategy for the company to be successful. If the corporate strategy mandates a growth plan, then capital must be ready and available. You can be profitable and go bankrupt if you mismanage your financing arrangements. If the corporate strategy is to maximize the cash flow for the shareholders, then a capital structure should be implemented to optimize the flow of funds and minimize the financing costs. Debt financing has a much lower cost than equity financing. So long as the operating cash flows are sufficiently stable to support the debt service costs, finding lower cost funds creates value for shareholders. Finally, not all businesses are enjoying growth or stability. Some face challenges for any number of reasons, and these companies still need to set a financing strategy to meet the needs of the business. The key priority in these types of situations will be the company's ability to access financing and the flexibility in the terms of repayment. Intimately understanding your corporate strategy will position you to seek out the sources of capital that best meet the capital needs. The types of capital vary widely on each of these dimensions, and in each of the lessons of this course we will look at capital in this context. The availability of the various sources of capital will depend on the nature of the situation and the characteristics of the business. The business does not have to access all sources of capital simultaneously. New startup companies are limited in their sources of capital. They typically do not have much access to debt financing and rely heavily on equity financing to get started up and get going. On the other hand, mature companies are less attractive to growth investors. But typically, these companies have assets and cash flows that can be used to raise and maintain and service debt financing. The amount of capital will be constrained by any number of factors, such as the security you have available to offer, the ability to pay financing costs, and the ability to meet financial covenants. Sources of capital can also widely vary, from your own personal savings, and perhaps those of family and friends, to banks, to pension funds, private equity funds, venture capitalists, and perhaps even retail investors someday when you take your company public. The term of debt can vary from short-term sources of financing, say credit from our suppliers, to term loans and permanent sources of capital such as common shares and preferred shares. The cost is an important dimension of capital. Some capital is available for free. Other sources are very expensive and can cost you 25% or more. The conditions associated with maintaining and establishing the financing are important. Some sources don't come with any conditions at all, say common shares, which makes it harder to get into trouble. Other sources come with stringent conditions, which if not met, could cost you your company. Other factors to consider impacting the availability of capital, aside from the company's position in the business life cycle, include the business attributes, which include the size of the business, the level of the profitability, the consistency of historical results, the experience of the management team, and the company's position in the market. The more favorable all these sorts of attributes are, the more financing alternatives that are going to be available. Different industries have different risk profiles. Some industries are very cyclical, such as commodity industries, which cause profits to fluctuate wildly. Industries such as consumer products, utilities, are more stable. Factors such as these impact the availability of various sources of financing. And regardless of the business and the industry, the reality is that the capital markets themselves have their own degree of cyclicality. IPOs may be hot one year and not the next. Banks may be lending to a specific sector one year, a different one the next, and not at all in the third year. This may be beyond the control of management, but must be factored into your financing strategy. Keep in mind that sometimes you may raise capital when you can, even when you don't need it. So to summarize this module, first, recognize that there are probably more needs for capital than you may have realized on first blush. Second, appreciate the objectives of capital. And also, recognize that the objectives of the shareholder and the corporation may conflict at times. Third, realize that financing strategy is not an isolated plan. It's integral to your overall corporate strategic plan. And finally, When you go to evaluate the different sources of financing, weigh all the dimensions of capital. These dimensions provide you with room to negotiate and make trade-offs. That's all for this lesson, so until next time, don't stop till you get to the top. When you get to the top, don't stop.